Before we deconstruct the exact mathematical mechanism that are about to drain your bank account, I have 3 critical questions for you to answer in the comments below. Number 1. Are you still negotiating your UAE-based salary on outdated assumption that your total compensation package is a 100% tax-free, untouchable asset? Number 2. If your employer suddenly faces a massive multi-million dirham corporate tax liability, do you understand exactly which of your housing, education, and travel allowance will be the algorithmic cut to protect their margin? Number 3. Have you audited your 2026 employment contract for the hidden compliance clauses that legally shift the corporate tax burden directly onto your monthly take-home pay? Let me know your answers. If you are new to the channel, here is my intro. I am Dr. HR. I approach the global labor and capital market not with emotional, comforting advice, but as a structural algorithmic system. I hold a PhD in human resources, a master's from prestigious Tata Institute of Social Sciences TISS in Mumbai, and a bachelor's in computer engineering. Operating on the ground here in Dubai since 2010, consulting for Tier 1 corporate entities, sovereign wealth funds, and apex tech founders, I have monitored exactly how global regulatory shift destroys the individual wealth. The market does not care about your lifestyle. The market cares exclusively about protecting the corporate balance sheet. We are going to analyze the brutal fiscal shift occurring right now in the UAE. As corporate tax exemption vanish and the regulatory environment hardens in 2026, firms are being forced to claw back their margins directly from your payroll structure. We are mapping the transition from a tax-free paradise to a calculated high-friction deduction landscape, exposing exactly how hidden compliance costs are actively eroding your monthly earnings. We must bridge the gap between the high-level macroeconomic policy and the actual cold number in your bank balance. Before I completely dismantle the illusion of a tax-free salary, expose the precise algorithms companies are using to slash your benefit, and give you an exact architectural blueprint to negotiate a tax-protected sovereign compensation package, hit the subscribe button and press the notification bell. I post daily videos showing you exactly how to navigate the global labor and capital markets using cold, hard engineering logic. You do not want to miss these execution protocols. Stop assuming your salary is safe. Start auditing your deduction. Grab a notebook. It is time to protect your capital. Phase 1. The end of a tax-free illusion, the fiscal shift. We must first diagnose the exact debilitating macroeconomic reality that employees in the UAE are blindly ignoring. For decades, Dubai operated as an ultimate global geo-arbitrage destination. You moved here, you negotiated a massive gross salary, and your gross salary was exactly equal to your net salary. The equation was perfectly frictionless. The corporation paid zero income tax, zero corporate tax, and distributed massive untaxed profit. In June 2023, the UAE introduced a 9% corporate tax on business profits. However, the amateur employee looked at this and said, "Hey, this is a corporate tax, not an income tax. It taxes the company's profit, not my salary. Therefore, my take-home pay is safe." This is a catastrophic failure to understand the physics of a corporate finance. The corporate balance sheet is a closed thermodynamic system. In 2023 and 2024, companies relied on transition period, complex restructuring, and generous grace period to absorb the initial shock. But the 2026 is a year of absolute unforgiving compliance. The leniency has evaporated. The audits are live. When a Tier 1 corporation or a massive logistics firm in Jebel Ali is suddenly forced to surrender 9% of its net profit to Federal Tax Authority, the executive board does not simply accept a lower valuation. They do not accept a reduction in shareholder dividend. They demand that the chief financial officer, the CFO, completely restore the margin. How do you restore a 9% loss in net profit? You cannot raise prices instantly because the global market is fiercely competitive. You must aggressively slash the operating expense, the OPEX. In any service, technology, or real estate firm, the absolute largest operating expense on the ledger is human capital. Payroll, benefit, allowances. Corporate tax is not just an accounting problem, it is a direct targeted attack on your compensation structure. The corporation is going to extract the 9% directly from the biological workforce. You are about to finance your own employer's tax bill, and if you do not understand the mechanics of the clawback, you will not even realize it is happening until your lifestyle completely collapses. Phase 2, the Margin Clawback Algorithm, targeting the allowances. To understand how the corporation extract the capital, we must reverse engineer the Margin Clawback Algorithm. The UAE labor law makes it exceptionally difficult for an employer to legally reduce your fixed basic salary without your explicit written consent. The CFO knows this. Therefore, they do not attack the base, they attack the periphery, they attack the variable matrix. In the UAE, standard executive compensation is highly fractured into allowances, housing, transportation, education, and communications. This structure was originally designed to optimize end of service gratuity calculation. Now it is the exact vulnerability the company will exploit. 1. The housing and the education freeze. You are an apex operator holding a contract that states your housing allowance is subject to annual market review. You are in immediate danger. In 2026, a Dubai real estate rents skyrocket. Legacy companies are actively freezing or reducing these allowances to offset their tax liability. They use internal HR algorithms to justify the freeze, claiming that the corporate overhead restructuring prevents them from matching inflation. Your rent goes up 20% and your housing allowance stays flat or drop by 5%, and your monthly take-home pay is mathematically devastated. 2. The phantom medical downgrade. Health insurance is a massive, highly variable corporate expense. To claw back margins, HR department do not cancel your insurance. They execute a phantom downgrade. They switch the corporate provider to a network that looks identical on paper but possesses massive copay, restricted Tier 1 hospital access, and lower pharmaceutical coverage. Suddenly, a basic family medical visit that cost you nothing in 2024 now cost you AED 500 out of pocket in 2026. The corporations saved millions in premiums to pay their tax bill, and they transferred the exact financial burden directly to your personal bank account. 3. The travel policy liquidation. For regional directors and sales executives, the per diem and the travel class protocols are being ruthlessly liquidated. Business class flights are downgraded to economy. 5-star hotel allowances are capped at 4-star rates. The difference in cost is absorbed back into the corporate treasury to satisfy the 9% tax margin. The corporation does not need to rewrite your employment contract to reduce your pay. They simply manipulate the environmental variable of your employment, systematically bleeding your monthly liquidity to protect their sovereign profit. Phase 3, the free zone exemption trap, the compliance cliff. The most violent financial shocks of the 2026 will not occur in the mainland companies, they will occur in the free zone. We must map the free zone exemption trap. When the UAE corporate tax was announced, thousands of companies operating in Dubai International Finance Center (DIFC), the Dubai Multi Commodity Center (DMCC), and the Dubai Internet City celebrated. They believed they were shielded because the law offered a 0% tax rate for qualifying free zone persons. This created a massive temporary illusion of safety. To maintain that 0% exemption, a company must prove they are generating qualifying income and maintaining strict economic substance within the free zone. In the 2026, the Federal Tax Authority audits are tearing through these companies. Thousands of firms are realizing that because they conduct businesses with mainland UAE entities or because their digital supply chain cross specific regulatory borders, they fail the compliance test. They are being retroactively disqualified from the 0% exemption and instantly hit with a standard 9% tax rate on their entire global profit pool. When a free zone tech startup or a boutique financial consultancy is suddenly hit with an unbudgeted 9% tax shock, the reaction is algorithmic and immediate: panic. The instant payroll purge. All pending promotions are permanently frozen. Mid-year bonuses are completely eradicated under the clause of unforeseen macroeconomic restructuring. Non-essential roles are identified through value stream mapping and instantly liquidated. If you are an employee in a free zone entity that fails its compliance audit in 2026, you will experience an immediate violent contraction in your earning potential. The company literally does not have the liquid capital to pay your expected end year bonus because that capital has been legally seized by the tax authority. You believed you were working for a highly profitable tax exempt entity. You are actually working for a structurally non compliant liability, and you are the one who will pay the price. Phase 4, the invisible bonus restructuring, the EBITDA hack. The most sophisticated and terrifying extraction protocol being deployed in the 2026 is aimed directly at the sales director, apex recruiters, and the C-suite executive. It is the invisible bonus restructuring. If you are an elite operator, a massive portion of your monthly or annual take-home pay is variable. It is a bonus or a commission tied exactly to the profitability of a company or your specific department. Historically, these performance matrices were tied to the gross revenue or pre-tax profit, the EBITDA. Let us run the mathematical physics of this hack. In the 2024, your department generated 10 million AED in profit. Your contract entitles you a 5% performance bonus on profit. You took home a bonus of 500,000. In 2026, the department works 20% harder. You generate the exact same 10 million in profit. You expect your 500,000 AED in bonus. But the HR department and the CEO, CFO has quietly updated the definition of the corporate KPI matrix. Your bonus is no longer the pre-tax profit. It is now explicitly based on the post-tax net profit. The company pays the 9% corporate tax. The 10 million profit pool instantly shrinks to 9.1 million. Your 5% bonus is now calculated on the reduced pool. You have reduced 455,000 there. You just lost 45,000 of your own biological capital without missing a single target, without losing a single client, and without your base salary ever changing. The corporation effectively utilized a semantic legal shift in your performance contract to force you to pay a percentage of their corporate tax liability. Furthermore, consider the massive compliance cost. To adhere to the new tax laws, the corporation must hire the Tier 1 accounting firm like Deloitte or PwC to audit their books. They must spend millions upgrading their Oracle ERP system to track taxable versus non-taxable routing. Where does the money for the software upgrade comes from? It comes directly out of the departmental's profit pools. This further drives down the net profit, which algorithmically drives down your variable compensation. You are being taxed. The government is not taxing your income directly. The corporation is acting as a proxy, silently extracting the toll from your value stream before the capital ever reaches your bank account. Phase 5, the sovereign negotiation protocol protecting the net. We have diagnosed the fiscal shift. We have exposed the margin clawback, mapped the free zone trap, and decoded the invisible bonus restructuring. You now must understand exactly how the corporate machine is engineering the reduction of your wealth. You cannot stop the macroeconomic tax law, but you can architect an absolute defense against the corporate extraction. You must deploy the sovereign negotiation protocol. You must stop acting like a passive employee who accepts a standard PDF contract. You must negotiate like a sovereign entity protecting a balance sheet. Step 1, the net guaranteed clause. When you enter a negotiation for a new role in Dubai or when your current contract is up for renewal, you do not negotiate your allowance as a flexible variable. You look the HR director in the eye and you deploy the protocol. Given the volatile compliance environment of 2026, I do not accept subject to company's policy clause for my housing and education allowances. My architectural baseline is a fixed, mathematically guaranteed dirham value that remains absolute, regardless of our internal corporate tax restructuring or OPEX reduction protocols. You force them to lock the exact dirham amount into a legally binding section of Ministry of Human Resource and Administration Mohore contract, entirely shielding your living expenses from the future tax panic. Step 2, redefining the variable matrix. If you are an apex operator relying on a profit sharing, you must aggressively audit the mathematical definition of profit in your contract. You state, my performance matrix must be contractually tied to the gross departmental revenue or a pre-tax EBITDA. My biological execution is responsible for driving top-line growth and operational efficiency. I am not a shareholder in this firm and therefore I will not absorb the financial liability or compliance software upgrades. My percentage is calculated before the government extracts its toll. If the corporate refuses, you instantly calculate the 9% algorithmic reduction into your base salary demand. You force the company to pay a higher fixed cost to compensate for the corrupted variable pool. Step 3. Broadcast your sovereignty. You cannot make these aggressive demands if you are easily replaceable. To pull off the sovereign negotiation protocol, you must possess absolute market leverage. You must build your proof of work. You step into your acoustic-treated digital studio. You deploy your elite Cineline gear, your Sony FX series camera with a razor-sharp cinematic lighting. You import your structural analysis model and value stream architecture into DaVinci Resolve 20. You record a highly structured, unsentimental video essay deconstructing exactly how your specific operational skills generate a massive tax-resistant revenue for global corporation. You broadcast this undeniable high-fidelity affect directly to the market. When a CEO watches that broadcast, they understand that you are not a standard employee begging for housing allowance. They recognize an apex structural engineer. They will gladly bypass their own HR cost-cutting algorithm to secure your talent, and they will sign the net guaranteed contract because you mathematically justify the premium. Look closely at your current payslip. Look at your end-of-year bonus projections. Are you blindly trusting the corporation to protect your wealth? Or are you actively auditing the hidden deductions? The 2026 corporate machine is in survival mode. It will ruthlessly protect its profit margin, and it will do so by silently bleeding yours. Stop assuming your tax-free lifestyle is a permanent. Audit the variables. Redefine your contract. Deploy the sovereign negotiation protocol and force the corporation to absorb its own liability. Process the data, execute the strategy, and I'll see you at the top.